And where US sovereign bond markets go, so goes pretty much every bond market in the world. Okay. So we don't like bonds.
Even in the corporate bond market.
It doesn't compensate for the risk of capital
No.
loss.
Yes, okay, if you're just looking at the US, it's bloody hard to find some decent dividend yield.
Shifting from equity to credit. So here's a question from Path. In the recent Howard Marks newsletter, he made a case to shift partial allocation from equity to credit due to high returns from the bond credit investments. One of the funds recommended is the iShares USD High Yield Corporate Bond ETF. Do you guys agree with this partial reallocation from equity to credit? And do you have a perspective on the High Yield Corporate Bond ETF as a diversification strategy? Thanks for all you do. Again, coming back to what we talk about, we're long-term investors. Our long-term multi-year view is that bonds are a dangerous place to be. We've just referenced the US fiscal situation, which is problematic to say the least. And where US sovereign bond markets go, so goes pretty much every bond market in the world. Okay. And then if you took, even if that was not the case, which it broadly is, even if you looked at the next largest bond markets, they're all in deep shit. So we don't like bonds broadly. It doesn't make sense for us. We do have a strategy to deal with that, insofar as if you're looking for an income, which is really what you're trying to do with bonds. There's two things that you do with bonds. One is you want to have principal secured, and the other one is to get an income. Our answer to that is our dividend income portfolio, and we'll give you a little sneak sort of preview into what that's looked like since we implemented it and how it's fared against yields or bond ETFs or any bonds.
This is the ETF AGG, which is a broad bond market ETF. Orange line, that is the total return of the bond market. So, all the dividends or interest payments that will come as per a dividend in the ETF that gets added back into it. Now, at the moment, so you can see that's obviously gone down since 2021. The interest rate, the yield there is about 3.5% plus or minus. If I was to include the ETF HYG, the dividend yield there is about 6%, and it's pretty much on par where it was in 2021 in terms of total return. So I do apologize. We probably should have had the high yield ETF up there instead, but it still hasn't done anything. It's still not that attractive. I mean, 6% yield, we do. The dividend yield we're getting, the dividend portfolio, dividend portfolio versus the ETF AGG, so it's total return. So fees, and it includes fees, dividends, etc. Well, I should say net of fees. The dividend yield we have is about 8.59%, which is handsomely outperforming the dividend yield of AGG, which is about 3.5, and also HYG, the high yield bond ETF, which is about 6.5%. And so on top of that, we also have the highly probable outcome of some decent capital gains. Going back to the original question, I don't think the yield is high enough, even in the corporate bond market.
It doesn't compensate for the risk of capital loss.
No. Yes, okay. If you're just looking at the US, it's bloody hard to find some decent dividend yields. If you, of course, outside the energy space. In the energy space, you can find them. If you go outside the US, it isn't hard to find companies with, cash cow companies, smaller cap type companies on dividend yields of about 10%.